Thank you for joining us on today's episode of The Capitalist Investor. I'm Mark Tepper, joined by Derek Gabrielsen. What up, D?
Mark, how's it going today?
Good, buddy. Good. So, look, man, we've seen the COVID-19 cases spike initially. We've seen them kind of fade, and we've seen a bit of a flare-up recently.
Yep.
So what I want to talk about on today's show is kind of the post-crisis investing playbook.
All right, let's do it.
So let's assume we get to post-crisis. We get through this little flare-up that we're dealing with right now, which I think is overblown, anyways.
It seems to be, yeah.
Yeah.
The deaths seem to be still trending in the right direction.
Yes, I mean that's really what matters.
Right.
Right. I mean, I don't think Trump did the best job of explaining.
No.
Maybe it was last week. Chris brought this up to me. What did he say? He's like, if we didn't test, there would be no positive. Okay.
I saw the clip.
I think what the dude was trying to say is the reason we're seeing more positives is because there are more tests.
Yes.
That's the way to say it.
Doesn't seem that difficult, but
yeah, he's funny with his words sometimes. All right, so let's assume we get through the crisis, or really, I mean, even if we don't, even if this lasts for a few years, which let's hope it doesn't. What is that investing strategy, right?
Right.
How should clients, how should listeners, what should they be doing differently to their portfolio that maybe they weren't doing a year ago? Right, so we came up with 5 different things, and I'm going to run everyone through all 5, and then we'll go and we'll spend some time on each of them. So the first thing is, from my perspective, I think you need to obviously reposition all of your holdings.
Right.
All right, basically getting out of the losers and into the winners, because there are going to be clear winners coming out of this, and you need to make sure you're in those positions. Second thing is canceling Autopilot. That's like the auto rebalance, right? That's the auto asset allocation. That's the target date 2030 fund, right? You have to have 4% in emerging markets. Says who?
Right.
If I don't want to own them, I don't want to own them.
Exactly.
Right? So canceling Autopilot is number 2. Number 3, you need to be tactical. Overweight sectors that you like, underweight sectors that you don't like. You don't have to just own the S&P as it is, right? There are ways to optimize your investment portfolio, and that's by being tactical. Fourth thing is you need to really get a portfolio stress test done on your current portfolio. All right, so we could certainly help out with that by helping to analyze what your current holdings look like, where your risk might be, things along those lines to help to get it set up so that it's basically ready to hopefully position you for optimal performance. And then the fifth thing is a financial plan.
Right.
Obviously, it's very difficult to figure out which investment strategy is right for you if you haven't done a financial plan first.
Right. It's going to be the key to figuring out, what your portfolio should look like.
Exactly. And I think it also helps you to make sure you can sleep at night.
Yep.
Right? I mean,
Absolutely.
If people have a financial plan and it's been stress tested, and it can weather a 20% downturn, drawdown, whatever you want to call it, and your portfolio is down 12%, and you remember that you just saw that your financial plan could weather that storm, you're probably going to sleep just fine at night.
Right.
So I think that's helpful. So those are the 5 things we want to talk about. D, let's start off with number 1, which is reposition holdings.
Yep. So, I think you have to start this off with everyone's new favorite phrase, the new normal, right? Mm-hmm. So that's doesn't matter what you're talking about. You were talking about the new normal.
Yeah.
So if we're talking about stocks or travel or visits to the doctor's office, there seems to be a new normal, is going to be thrown in there. And look, it's with the news changing almost hourly, it seems.
Yeah.
I can remember a couple days ago, the China talk came out in kind of like the middle of the night.
Yeah.
And the futures crashed, and then
the trade deal was donezo.
Yeah, exactly. And then
the next morning it wasn't donezo.
By the time I pop it up at 7 a.m., it's swung 2% into the positive range. So, there's everything that we're seeing now is obviously pretty fluid. but there are going to be clear winners and losers going forward.
Yeah.
I think is really starting to shape up that way. And as the days go on, it seems to be even more apparent that we're going to be entering into a new economy, right?
Yeah.
And I've seen there's a lot of stuff out there on Twitter, which I know you know about, and everyone seems to have a theory. But absent a cure for COVID-19 or getting down the road on a vaccine and actually getting it out there in the public, you can't just expect every single stock out there just to kind of pop up back to the levels that it was before this thing all started.
No, there's going to be permanent changes.
Yeah.
Yeah, without a doubt.
Amazon, we've talked about before.
Clear winner.
Well,
they're a winner at the expense of a lot of small businesses.
Yeah, that's for darn sure.
Right? I mean, these small mom and pop shops, they've gone out of business. And who got the business? Amazon.
Yep.
Right?
And we've talked about all that stimulus helicopter money that went out. Where did it all go? Well, the grocery stores, Costco, Amazon.
Exactly.
So, and then there's going to be some clear losers,
Department stores.
Yeah.
Right? I mean, Macy's, Kohl's, Nordstrom, which, I've always liked Nordstrom because I thought it delivered the best customer experience.
Mm-hmm.
But who's going to go there, man? I mean, it's just... Nobody was going there before the crisis. So who's going to go now? You look at the airline stocks.
Yeah.
I mean, American Airlines a couple weeks ago went from $10 to $20 back down to $15 all in a week.
Right.
And there are literally rookie novice investors out there on their Robinhood apps buying this stuff.
You hit the nail right on the head on that one.
Dude, you got $1,000 to your name and you bought a bunch of American Airlines stock with that? Come on.
And it swings 5% at least every single day.
Yeah. Well, it's either one of the biggest gainers or the biggest losers in the S&P every single day.
Almost every day.
All the airline stocks, the cruise line stocks, hotels. They're risky.
Right.
I mean, could they muscle through this and come out the other side? And I don't know that they'll be stronger, but could they be healthy? Yeah, it's possible. But, man, you want to bet the farm on that?
Yeah, and when is that going to happen?
Right. How long is it going to take? I mean, the last I checked, TSA traffic was down 80% year over year. 80%.
I saw pictures today of LAX. There was literally not a soul there.
Ghost town, huh?
Complete ghost town.
Yeah.
So, those stocks, we'll get into this a little bit as we go through this list more. But right now, it's a pure gamble, right?
Yep.
You're putting in some pretty heavy speculation for any of these airline stocks or travel stocks or cruise stocks to get back to that number that they were at before all of this started. I mean, we just don't know.
Yep.
But what we do know is that there's a reason that the airline seats are now about 6 inches big, right? Because they're trying to pack as many people into those planes as they can to be as profitable as possible. So a 60% model, 70% capacity model, it just doesn't really work for them.
No, it doesn't work. All the middle seats are now open, right?
Mm-hmm.
First class, they're only booking like one seat per row.
Mm-hmm.
No, it's not a model that's sustainable,
right?
So, just so we can kind of move on from repositioning holdings, just one last thing I want to bring up. What I think most people should be doing right now is coming up with a list of all of their favorite stocks, right? Come up with a list of your favorite stocks, preferably in themes that you have conviction in,
right?
Whether it's workout from home, right? And the stock that you like the most might be Peloton or whatever the theme is that you think is going to persist and survive and thrive through the crisis and after the crisis. Come up with the themes, come up with the stocks that fit those themes, and identify the price, which should be lower than the current price, at which you would be really excited about investing in that company, assuming that the fundamentals of the company don't change, right? if Peloton suddenly said they forgot how to make their Peloton bike, I would consider that to be a fundamental change in the company, right? You come up with that list and you wait for these positions to fall into your lap. And you know, if you get some and you miss out on others, that's okay.
Yep.
You made a smart decision and you paid attention to your entry price. And the number one determinant of long-term performance is what you paid to get in the first place, right?
No doubt.
You know, come up with your list and wait for these positions to fall into your lap at a price that you'd be comfortable with. Okay.
Have you bought Lululemon yet?
No, because it's always too expensive. It just gets more and more expensive.
Bro,
I've been waiting for it to fall to like 150 and then 180, and
I don't remember what day
did.
it was, but it was like 165.
Yeah.
And it was like a horrible day. You know, it was like a minus, 7% day or something like that.
Yeah.
And I had it on my screen. I'm like, man, I should really buy that.
Yeah. I mean,
but obviously the everything was just going wrong at that time.
Well, their stores were closed.
Yeah. Mm-hmm.
Right. So I'm like, all right, well, if I liked it at 180 before and their stores are closed, I'm not overly excited. But you know, the thing that it makes you look like a fool day in and day out for not owning it.
Yep. So now it's up. It was over 300, I think, there for a while. It's back just under 300 now. So
yep, not too shabby.
So yeah, build your list. You're not going to hit them all, but at least you'll have that list. And
that's one that I will never hit on.
Yeah. I feel like I should just buy it now at 300.
My entry price is always going to be lower than the stock price will ever be, right?
Yeah, exactly.
So unfortunately, and you know what? I'm not upset about it. I wish I owned it. I wish I bought it at 100 or 150, but it's always been out of my price range, and that's okay. I missed it.
Right.
That's fine, guys. It's okay to miss. But there's lots of others that you're going to hit on along the way, and you're going to be smart and prudent about it, right? Which really matters when it comes to performance, but also risk management, right? All right, D, let's move on to number 2, canceling Autopilot. So, look, the most turnkey way to set up your 401k without even looking at the mutual funds is basically just to pick a target date mutual fund. Right? I think I'm going to retire in 2030, 2040, 2050, whatever it might be, and you set it and forget it. Well, I would argue that now is not the time to be doing that.
Right.
I do not think you should be setting it and forgetting it. For somebody to pull out their mathematical model and to tell you that you should have 4% in emerging markets and 5% in small cap and 7% in mid cap. Like, it's a bunch of baloney.
Yeah, exactly.
Right? Like, it just, yes, academically it works. If I look backwards, right? And I look at correlation matrices and stuff like that, sure, it works. But is it going to work right now, or would you rather be focused on positioning your portfolio in the asset classes that you think have the best risk-reward profile for you over the course of the next few years?
Yep.
That's what I would want to be doing, right? We talked about this on prior shows, like small cap stocks in particular, right? So, over 40% of small cap stocks make no money. No money at all. Yet the index is doing pretty well, right? And in times where small businesses are being hurt disproportionately to large businesses, do you want to own companies that are making no money, that have high debt payments? Like, it doesn't make sense.
Right.
Valuation doesn't matter until it matters, And that's the one thing I can say about the stock market today is that everything's overvalued. But it's also very likely that everything continues to become more and more overvalued.
Right.
Especially with the Fed dishing out $1 trillion here, $1 trillion there.
Yeah.
Right?
Blank checkbook from the Fed is definitely going to prop up the prices in the market.
Right. D, what's your take on the whole autopilot, set it and forget it strategy?
All of these are obviously important, but I think if I had to pick one, this would probably be number one on my list, the most important thing that you could do right now, because it just intuitively makes sense from everything that we've been talking about, throughout a lot of this season too. It kind of ties back into a little bit of the passive versus active investing. There's nothing that says that you have to have a certain percentage in these certain asset classes, especially right now. It's when the markets are volatile like this, one of the most important things that you can do is try to reduce that volatility as much as possible.
Exactly.
And a lot of these asset classes that are in a lot of these set it and forget it type of portfolios or mutual funds in your 401k, they're going to be set it and forget it type of models. And, and this stuff changes daily, but, do you need to have that historical full weight to emerging markets right now?
Probably not.
Probably not, and to be able to do that, and look, there's a lot of different, demographics listening to this podcast right now. But if you're approaching retirement, you're probably in a different investing stage in your life than like you and I talking about Lululemon, right? Completely different stages in life. So make sure you understand what your goals are and then properly address them based on what's going on in the world today.
Yeah, no doubt. All right, number 3, be tactical. So this refers to overweighting and underweighting specific sectors within your holdings, right? So, as an example, we like tech.
Right.
We're overweight tech. That's good. Yeah. Assuming tech is a winner, which it has been, and we think it will continue to be a winner, that should help our cause.
Right.
Right. We're overweight healthcare. Right. Assuming, healthcare is obviously a big concern for a lot of people right now.
Right.
At least COVID-19 is. Okay. But the real C word is still cancer.
Right.
Okay. And at the end of the day, once we have a solution for COVID-19, whether it is more effective treatments or a vaccine or whatever it is, you still need to deal with cancer, right? And all the other illnesses that are out there. So healthcare is a big sector that we're overweight. And if you think about it, we do have an aging population here in the United States.
Right.
I don't know the exact statistic, but it was something like the 65 plus crowd. That crowd was going to grow at like 3 times the pace of the under 65 crowd over the next 10 years. It was something very significant, right? Where you're going to have more people that are getting, a little bit older, getting up there in age, that are going to need some medical treatments of some sort. So we like being overweight healthcare. And then you look at like utilities. I'm sorry, I'm just not that interested. You know, so we're underweight, right? Basic materials. Well, I think we're battling deflation, not inflation. So, do we want to own the basic materials companies? We probably want to be a little light there, right? So it's all about overweighting and underweighting based on your best ideas.
Right.
What's your take on that?
Yeah, it kind of goes into my point from canceling the autopilot on number 2 there. It's important, and I think just kind of reading what's been going on out there and trying to understand people's thought process. You don't need to make these giant bets, right? Like we're just talking about airlines. Like if you keep trying to time up the airline bet, you're eventually going to be wrong.
Yeah.
Even the greatest investors in the world with the most experience, they're eventually going to be wrong because it's pretty much impossible to time the market on these things.
Right.
So, underweighting and overweighting for people listening out there, I think is super important. It can help you with performance for sure.
Yeah.
But it's going to help you outperform the index, like the S&P 500.
Yeah.
But it's also going to keep your risk down, which I think is
right, because you're not going all in on airlines, right?
Exactly right.
You're overweight something because you like it a little more, or you're underweight. We're not saying zero exposure here.
Right.
All of our exposure there. I think you put that perfectly, D.
Yep.
All right, number 4, portfolio stress test. So if you have an advisor, you should ask your advisor to run a stress test on your portfolio. If you're a retail investor, figure out if there are some tools out there. What we do for our clients, or prospective clients, I should say, that are interested in working with us, is we put together a complimentary portfolio stress test, right? Where we take a look at all their holdings, we analyze them, we let them know, where they might be taking on an excessive amount of risk. Look at the total expenses associated with the strategy, if they're in ETFs and mutual funds, sector overweights, underweights, and just have a good discussion about why they're doing what they're doing. Right. I think it's important that everybody do this on a regular basis, right? I mean, if you set up a portfolio a year ago and you haven't had a stress test done on it to figure out, is it going to work in the, as you said, the new normal,
Right.
then you're really missing an opportunity to figure out where the problems are in your portfolio, which opportunities you might not be taking advantage of that you should, and you can get that ship righted.
Right. For sure. So I'm going to stick with number 2 as my favorite, the make sure you're not on autopilot, but yeah, man, a portfolio stress test is just so important. It's important today, but it was also important, January 3rd, and it was also important in July of 2015. We don't know what's going to happen in the market day to day. It's important that your portfolio matches the amount of risk you're willing to take.
Yep.
It's just so important. Number one, for the performance of your portfolio and hopefully your retirement plan as well. But I mean, man, oh man, people need to be able to sleep at night, right?
Yeah.
and this is really a key factor to letting people know what their overall exposure is.
Right. I mean, we had a prospective client we were meeting with a few of the other gentlemen in the office and myself. We met with this guy maybe like 3 weeks ago. Very heavy concentration to Regeneron, which is a biotech company. It was like a double-digit weighting in his strategy, which has worked very well this year because the stock has just taken off along with all biotech stocks.
Right.
But do you really want 10, 12, 15% of your portfolio invested in one company? That's a lot of concentration risk.
Yep.
So it's worked well. A lot of people would be sitting pretty, thinking very highly of themselves for that. But at the same point in time, maybe you should just be playing with the house's money there.
Right.
Take some chips off the table, right?
For sure.
And if you want to be overweight Regeneron, that's fine. Totally fine. Mm-hmm. Maybe your standard holding in your portfolio is 3% and you want to hold Regeneron at 5%. That's cool.
Yep.
Totally cool. But we need to identify where the potential issues and risks are in your portfolio. If you're not working with us and you'd like to have us take a look at your portfolio, feel free to shoot us an email at info@swpconnect.com, and we would be happy to help you out and then chat with you about it. D, last thing, the fifth thing, financial plan.
Yep.
It's really the starting point for all this stuff.
For sure.
We're covering it last, but I think it's where you need to start first.
Yeah, no doubt. And, we've done a whole show on it. It always ends up in a conversation about investing, to know kind of where you need to be as far as risk tolerance goes. Because, everyone comes in to our office basically looking for the same thing, right? Yep. They want to make as much money as possible with the least amount of risk.
Exactly.
So
you want to work a miracle.
Yep. Actually, I didn't, completely off topic. I got a text message from my friend he was our same age, around 40.
Ooh, don't say that.
Yeah, I know you haven't hit that.
Yeah,
Cross
you
that.
have. Happy birthday, by
yeah,
the way,
thank you. So,
folks, I'm not there yet. Let it be known I'm not there yet.
You only got a couple months, though, right?
Why are you telling people?
I mean, 2 years and 2 months. So, but yeah, so he texted me. He's like out of the blue, right? We're talking about, football or something before this. And he's like, hey, D, I need a surefire way to double my money in about 2 weeks. You got anything for me? If you know this guy, he was being completely serious about it too. So I was like, well, yeah, exactly.
Yeah.
Take all your money, put it on black.
Yeah.
On the roulette table. So, you got to understand what your risk tolerance is. But But you need to know what you need to get, right? You need to know what you're shooting for.
Yeah. Yeah.
And that financial plan is going to tell you, right? It's going to tell you, hey, if I get a nice, smooth 4%, annualized rate of return, my plan may work out just fine.
Yep.
But also, hey, if I might need a 13% rate of return to make this plan work.
If that's the case, you need to really go back to that plan and figure out what you can do to make that a reasonable rate of return.
So, the earlier that you can start the change of plan, if that 13% number comes your way, the better off that you are.
Yeah.
So,
you know what, D? I want to talk about this while we're on this subject matter. So, a good majority of our clients have always been pre-retirees and retirees.
Right.
50-year-olds, 60-year-olds, 70-year-olds, and so forth. I don't know about you, but me personally, I've been working with more and more younger clients, some well-to-do, business owners and executives that might be, 35, 45 years old. So the situation's a little different, right? And I think when let's assume you're 62 and you're thinking about retiring at 65, a lot of those 62-year-olds, they understand the value of doing a financial plan and updating it every year.
Right.
I can't say the same for someone who's 40. So they don't, in my opinion, and this is anecdotal, this is just my limited, personal experience, but they don't value having the plan done every single year as much. What's your take? I mean, does someone who's 40 years old, do they need a plan update every year? And it's just kind of a smaller scale appointment to review that? Should they be getting their plan updated every 3 years, 5 years? I mean, what's your take on the younger listeners we may have on our, they're tuning into our podcast regularly? What's your take for those people?
Yeah. So, I would say, that typical client that we have been working with, let's just say, for the sake of argument, they're 65. We usually take our financial plans out to age 95, maybe even a little bit higher in some cases. So we're planning for, roughly 30 years of their retirement.
Yeah.
Right? If you're doing the same thing for a 40-year-old and you're planning for age 95, again, I was told there'd be no math, but that's 50 years.
55 years.
So when the period of time is longer on a financial plan, the projections really kick in, and you can end up with something that, may not look realistic, right? Because if you're applying, even a
best case scenario,
exactly,
I get $1 billion.
Yeah. So
right.
So in that is correct, right? It's not going to probably work out that way when we're simulating 50, 55 years, right?
Yeah.
But what it does do is it tells you directionally, are you headed in the right direction?
Yep.
Right. So to answer your question, I would say yes. If I was a well-to-do 40, 45-year-old, the planning as far as how much money we're going to have at the end of the plan and are we going to make it in retirement, those answers are probably going to be yes, we'll have plenty of money and, we're going to have a nice chunk at the end. But what's more important in that annual planning review, in my opinion, is to make sure our current position is correct.
Yeah.
Make sure nothing has changed over that previous year that we need to adjust for.
Yep.
For example, health, right? Insurance is life insurance is much cheaper for people who are in good health than someone who has a diagnosed condition.
Correct.
So while life insurance may not be the most sexy topic to talk about, and quite frankly, it's sometimes an awkward conversation talking about when someone's going to die, with them.
It shouldn't be, though.
No.
Right? I mean, it should be a love-based conversation where you're thinking, seriously, like, I love my wife, I love my kids, right? I want to make sure that if something happens to me, they're taken care of. So it shouldn't be a morbid conversation. Right?
So yeah, maybe what we're doing with our life insurance last year is there's something has changed and we need to revisit it.
Yeah.
Income, right? Pension plans. If you're still lucky enough to have a pension, I've seen those things just whipsaw all the way around all the time.
Oh, God.
So whether it's lump sum or what they're going to get every month. So,
and how are those pensions how are they going to be after COVID?
Right.
I mean,
they're all drastically
underfunded.
underfunded.
In trouble. Yeah.
So yes, I don't think you need to be, 3 months away from retirement to build out a financial plan. And I've been telling people this for years. The earlier that you can do it, the better off you'll be.
Yep. So build that plan and update it frequently, right? So I would say if you're a pre-retiree or a retiree every year, if you're younger, maybe you can get away with every other year.
Yep.
Right? Because, maybe the big things aren't changing, right? So, hey, that wraps up today's show. Again, the 5 things. Number 1, reposition your holdings. Number 2, cancel Autopilot. Number 3, be tactical. Number 4, stress test your portfolio. Number 5, build and update a financial plan regularly. So that wraps up today's show. If you'd like to shoot us an email, ask questions, comments, or if you'd like to take advantage of a portfolio stress test, shoot us an email at info@swpconnect.com. Also, we've been posting these on YouTube, so you can find the YouTube channel right there in the show notes. And as always, we thank you for joining us, and we will talk to you next time.